Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, May 5th, 2010. The euro-dollar pair continued to tumble today as it hit a new 14-month low, extending earlier losses as we had news that Moody's Investor Services placed Portugal under review for a downgrade which accentuated Eurozone sovereign debt fears. The dollar was a main recipient of safe haven flows and was higher against most of its major counterparts in today's trading. We see that throughout most of the Asian and European session that we had been consolidating following a very sharp slide in yesterday's session, but then once this news regarding Portugal credit rating being under review, we had another sharp swing down, putting us 200 pips lower, about 200 pips lower from our high to our low, though in New York morning trading we have managed to pair some of the sharper losses at the end of this downswing. The fear that Moody's would downgrade Portugal's AA2 government bond rating by 1 or 2 notches, increased fear of contagion, and if the yield or the borrowing cost for Portugal to finance its debt continues to rise, we can see the country face similar problems to finance its obligation that Greece ran into. Right now, it doesn't seem that the Eurozone has a plan to deal with other periphery Eurozone nations after bailing out Greece with the 119 billion euro deal we heard over the weekend. So far, there isn't much coming from official EU sources or ECB policy advisors in order to change the perception of the market. We do have the ECB deciding on interest rates tomorrow, which will be followed by the ECB President Trichet's conference, and I'm sure he will be getting lots of questions about the ongoing Greece debt crisis. One question he is sure to face is that the ECB has done a U-turn in that it says that it will now accept Greek bonds as collateral for loans to Eurozone banks, even if they have been downgraded to junk status. So that move flew in the face of a declaration by Trichet earlier this year that the central bank wouldn't alter its collateral rules for the benefit of a single country. The question now is, will they do a similar about-face for other nations if required? The decision to allow a country-specific exemption for Greek collateral either suggests that the ECB has given in to political pressure to provide help to one country in the Eurozone, or implies that the ECB interpreted the free fall of the Greek bond market as creating a systemic risk for the Eurozone. Either way, both scenarios are bearish for the euro, and we've seen that borne out in the sell-off in this week's trading. The market's reaction this week to the Greece bailout may leave the ECB little choice but to consider options such as doing away with collateral rules for other Eurozone countries, or possibly purchasing bonds, which so far the ECB has been reluctant to do, while other banks like the Fed and the BOE have done, which was quantitative easing. However, it's hard to do quantitative easing when the economy is recovering. So these are going to be the questions faced by Trichet, and we'll see what he'll say in tomorrow's press conference. In one more note, we had further fueling negative sentiment were reports that 3 people were killed on Wednesday after demonstrators protesting the Greek austerity measures set fire to a bank building in central Athens. So lots of heavy rioting as a result of the planned cuts by the Greek government. So all in all, another very poor day for the Eurozone and the Euro, and we see that since we tested this 137 level in the wake of our first announced 45 billion euro aid deal for Greece, the market has been selling the euro, and once we broke this 131 level in this week's trading, we've sunk very sharply down to 128 to set a new low, 14-month low. So I would say that a lot rides on ECB Trichet's performance tomorrow during his press conference, so definitely keep your eye out on that. Taking a look at the euro against the yen, we see that in today's trading, we moved below our support that we had mentioned in yesterday's video at the 122.50 level, and we slid all the way down to 120.70. So that goes back to our lows back here in March 5th. So we're at about a 2-month low for this pair. The dollar-yen pair, which did slide in favor of the yen in yesterday's trading, rebounded in the Asian session, and it retested our high just below 95, and used this 50-period moving average in our 1-hour time frame as support up until around 9:10 a.m. in New York trading. So even though the greenback was quite resilient as a result of a strong dollar overall in the currency markets, it did give way, and the yen managed to fall all the way down to 94, which was our 200 period moving average. So while we did move below this level of support from yesterday's session, 94.30, which was an old level of resistance, we still remain above this second level of support at 93.85. So if you have a continuation of this down move, this will be the next level to monitor carefully. Risk aversion extended to commodity currencies. Here we take a look at the US dollar, Canadian dollar, and we saw a strong surge in yesterday's session, and without much of a correction, we saw the pair move from the 1.0250 level all the way up to 1.0350, 100 pip move, though the test of that area was rejected rather strongly, and by noon New York time we had seen the pair cut most of its earlier gains. Zooming this pair out, we see that today's move broke above resistance level, going back here to March 26th at the 1.03 level. Oil prices slumped for a second day, with oil falling below the $80 a barrel level in early Wednesday trading. It was rebounding somewhat in the New York session, which helped to give the Canadian dollar this chance to pair these earlier losses to the greenback. The Aussie, which had consolidated similar to the euro dollar during most of the Asian and European session, slid further down to the 0.9020 area in the opening of New York trading. Though similar to the Canadian dollar, we have seen a bit of a bounce back, and we move back to the range we had in the overnight trading. In the U.S., even though U.S. equities opened lower, we did have U.S. stocks shave their earlier losses, so that is helping some of these commodity currencies and higher yielders to recoup their earlier losses. So while today's risk aversion took a heavy toll on the euro, we are seeing that at least traders in the U.S. are starting to widen their view to include corporate results and the domestic recovery, despite the European troubles, which depressed shares heavily in yesterday's session. Doesn't seem like these worries about contagion are going to go away overnight, and so now it's just uncertainty that hangs over the markets. We'll see if Trichet is able to dampen some of the lack of confidence in tomorrow's meeting. Taking a look at the fundamental docket for the upcoming session, we have some important releases from New Zealand and Australia, including New Zealand employment change for the first quarter, as well as Australia's retail sales and trade balance. Overnight, Switzerland posted on consumer prices, the UK releases its services PMI, and we get the results for the UK parliamentary elections. Also, Germany releases its factory orders. As I mentioned throughout the broadcast, we will get the ECB interest rate decision at 7:45 a.m. Eastern tomorrow, which will be followed at 8:30 by Trichet's press conference. From the U.S. Tomorrow, we get weekly jobless claims as well as labor productivity and costs data. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you good trading.